Markets are fascinating in the way they seem unpredictable, yet predictable at the same time. And if there's anyone who has mastered the art of seeing the patterns beneath the chaos, it is Howard Marks. He is not just another investor, he's the co-founder of Oaktree Capital Management, one of the world's most respected authorities on risk, cycles, and human behavior in markets. Marks has spent decades observing financial markets, and he often says the most important lesson investors can learn is deceptively simple markets move in cycles, and these cycles repeat themselves again and again throughout history. It is not a fancy formula. It is not insider knowledge. It is human nature, economics, and psychology all wrapped together. At first glance, this seems obvious. After all, we experience booms and busts, expansions and contractions, growth and recessions. But what Marks emphasizes is the pattern behind the pattern. He points out that the ups and downs are not random. They're driven by recurring forces, greed and fear, optimism and pessimism, leverage and deleveraging. Think about it: during boom periods, optimism surges. Asset prices rise. Credit is easy. Investors take on more risk because past performance seems to justify it. Everyone believes the good times will last forever. And then, inevitably, something shifts, inflation rises, interest rates increase, or a shock occurs, and suddenly confidence falters. Fear takes over. Markets contract. Leverage that seemed like an advantage turns into a liability. The cycle moves into its down phase. Howard Marks has repeatedly argued that recognizing where we are in the cycle is more important than predicting exact prices. Timing the exact bottom or top is almost impossible, even for professionals. But understanding the cycle's dynamics allows investors to adjust risk, position portfolios prudently, and in some cases profit from the irrational behavior of others. He often compares investing to surfing. You cannot control the waves, but if you understand their rhythm, you can ride them rather than get crushed by them. Market cycles are like those waves. They follow a rhythm driven by human behavior, leverage, and liquidity, and recognizing that rhythm is key to survival and success. One of the reasons cycles repeat, according to Marks, is that human behavior never changes. We have the same fears and the same desires as investors did decades or centuries ago. When prices are rising, euphoria clouds judgment. When prices fall, panic drives decisions. Each generation of investors experiences the cycle as if it is so new, even though it is a replay of past patterns. Leverage is another crucial factor. Borrowing amplifies returns in good times, but it also magnifies losses in bad times. Marks has often warned that the financial system behaves like a feedback loop. Optimism encourages borrowing, borrowing inflates asset prices, and when the tide turns, those same forces accelerate declines. This is why bubbles form and bursts are so severe. But there's a deeper layer. Marks stresses that cycles do not just repeat because of human emotion. They repeat because structural forces interact with psychology. Credit availability, monetary policy, fiscal policy, technological innovation, and global events all influence the timing and intensity of cycles. Even though the catalysts may differ, from the tech bubble to housing crisis to energy shocks, the underlying pattern of greed and fear repeats. He also emphasizes asymmetry in risk and reward. In rising markets, it feels easy to take risk because returns are visible and abundant. But risk is often hidden until it is too late. Marks says investors tend to underestimate risk during expansions and overestimate it during contractions. This misperception is another reason cycles repeat, because the collective misjudgment of risk drives both booms and busts. Timing is never perfect, but understanding cycles allows investors to make decisions based on probability rather than certainty. Marks often discusses the importance of defensive investing during the late stage of a cycle and taking advantage of opportunities during the early stage of recovery. It being cautious when others are aggressive, and being aggressive when others are fearful, that is a recurring theme in his writings. Here's an interesting observation: Marx makes cycles often appear to change because markets innovate or conditions evolve, but the underlying human tendencies are constant. The financial instruments may be new, derivatives, cryptocurrencies, complex structured products, but the human behavior behind them remains the same. Optimism, risk appetite, overconfidence, panic, and herd behavior continue to drive price swings. Marx also explains that cycles have different lengths and intensities, but the sequence is consistent. Expansion, peak. Each phase carries lessons for investors. Expansions teach the dangers of overconfidence. Peaks teach humility. Contractions teach the cost of leverage. Troughs teach the power of patience and opportunity. Those who internalize these lessons understand why markets repeat patterns. One of his most repeated warnings is that what the crowd thinks is safe is usually risky, and what the crowd fears is usually safe. This insight captures the cyclical nature of markets. Sentiment extremes are often contrarian indicators. During exuberant periods, valuations can become dangerously stretched. During panic, bargains appear. Recognizing extremes in sentiment is often the key to understanding the cycle's current stage. Marx also points out that cycles are not just financial phenomena, they're social and cultural. Policy decisions, societal attitudes, and collective memory influence market behavior. After major downturns, regulations may tighten, risk aversion rises, and credit conditions become conservative. Over time, memories fade, complacency grows, and the cycle begins anew. The lessons of history are rarely applied perfectly, the patterns merely reset. It is why Howard Marks emphasizes that history is a guide, not a guarantee. Every cycle has unique characteristics, but the repeating forces, greed, fear, leverage, liquidity, human behavior, remain the same. Studying past cycles equips investors with perspective and judgment, even when the specific circumstances differ. Another key idea Marx stresses is humility. Investors who believe they can predict markets with precision are often the most exposed when cycles turn. Those who recognize uncertainty, expect volatility, and prepare for multiple scenarios tend to endure and prosper. This mindset is central to his philosophy. Cycles are inevitable, but suffering from them is optional. Preparation, discipline, and understanding reduce the risks inherent in repeating patterns. Interestingly, Marx also highlights the role of patience. Cycles do not move in straight lines, and markets can stay irrational longer than expected. Those trying to force timing often fail, but disciplined investors who understand the rhythm of the cycle and the extremes of human behavior can identify opportunities during periods of fear or excess. The implications extend beyond investing. Market cycles reflect economic cycles, which in turn mirror broader social and political dynamics. Recessions can prompt policy shifts. Booms can inspire innovation. Understanding cycles is not just about money, it is about interpreting the forces shaping economies and societies over time. Marx's philosophy boils down to one simple truth: history does not repeat exactly. Recognizing the rhyme allows investors to act intelligently, anticipate risk, and seize opportunities, rather than being swept along by emotion. And here's the subtle but powerful point Howard Marks often emphasizes: cycles are as much psychological as they are financial. People forget the pain of prior downturns faster than they recall the lessons. Optimism creeps in, leverage builds, and markets stretch valuations beyond sustainable levels, setting the stage for the next contraction. Conversely, fear clouds judgment during troughs, creating opportunities for patient, disciplined investors. Marx teaches that understanding this emotional rhythm is just as critical as analyzing balance sheets or economic indicators. Those who internalize both the quantitative and behavioral aspects of cycles are best positioned to navigate the inevitable repeats. The cycle doesn't care who you are, it just unfolds. So why do market cycles always repeat? Because human nature leverage credit availability, and liquidity respond predictably to optimism and fear. Instruments and policies may change, but the underlying forces persist. Each generation encounters the same patterns, believes they are unique, and then experiences the consequences anew. And Howard Marks reminds us that acknowledging this fact is what separates successful investors from those who suffer from the cycles they fail to understand. If you think about it, the repeating nature of cycles is both a warning and an opportunity. When others panic, patience and preparation create advantage. When others are greedy, caution preserves capital. Cycles are inevitable, but suffering in them is optional. The wisdom Marx offers is timeless: learn from the past, respect the cycle, remain humble, and recognize that human behavior will always drive the repeating patterns of markets. Because no matter how much technology, innovation, or policy evolves, the rhythm of greed and fear keeps the cycle alive again and again.